Mr. AG Asian Guy here. Friday was one of the most important days for the silver market we have had in weeks, and most people missed what actually happened. While the mainstream financial media was busy covering earnings calls and tariff headlines and the same recycled macro debates they run every single week, silver quietly did something that changes the entire technical picture. It broke through $78 resistance with a move of more than 6% in a single session. That is not a slow grind. That is not a crawl above a level. That is a decisive breakout, and it did not stop there. Overnight, the move continued straight into the next resistance zone at approximately $86.50, which is where the price sits right now as I record this. Let me say that again because I want the numbers to be crystal clear. Silver spent the previous week meandering around the $78 level. It had actually closed below that level the week prior. Bears were in control. The tone was heavy, and then on Friday, February 20th, bulls showed up with force and pushed the price clear through $78 resistance with a 6% plus move. That momentum carried into the overnight session, and silver tagged $86.50. In roughly 24 hours, silver moved from a level where it looked vulnerable to a level where it now has a clear path to $93 and beyond. Now, before I go further, I want to hear from you. Where are you watching from right now? What country, what city? Drop it in the comments. I ask this every time because I want to see how far this community reaches. And I also want to know, did any of you catch that Friday move? Were you positioned for it? Did you buy the dip at $78, or did you watch it rip without you? Tell me honestly, because there is no judgment here. We all learn from each other's experience. And if this kind of real-time technical and fundamental analysis is helping you navigate this market, type MRAG Asian Guy in the comments. That is how I know this is connecting, and that is how I know what type of content matters to you. Now let me walk you through the technical roadmap because this is the clearest I have seen the silver chart in months. The support and resistance levels are well defined, and they give us a concrete framework for watching what happens next. You do not need to guess. You just need to know the levels and watch how price behaves at each one. First level, $78. This was resistance. It is now support. That is how technical analysis works. When price breaks through a resistance level with conviction, that level flips and becomes support on any pullback. If silver pulls back from $86.50, the first question is whether $78 holds. If it does, that confirms the breakout was real and buyers are defending the level. If it breaks back below $78, that tells you the breakout was false and the bears are still in control. Simple as that. $78 is now the line in the sand. Second level, $86.50. This is where we are right now. This is the current resistance. Silver has tagged it but has not broken through it yet. How price behaves at this level over the next several sessions will tell us whether this move has more gas or whether it needs to consolidate before attempting the next leg. If silver consolidates between $78 and $86.50 for a few days and then pushes through, that is healthy. That is a bull flag. That is the market building energy for the next move. If it gets rejected hard at $86.50 and falls back towards $78, we need to watch that support carefully. Third level, $93. This is the next resistance above $86.50. It is approximately $6 to $7 higher from current prices. If silver breaks through $86.50 with the same kind of conviction we saw on Friday, $93 becomes the target. And here's what makes $93 important. That level is close enough to $100 that the psychological gravity of triple digits starts pulling on the market. When silver gets to $93, every trader, every investor, every algorithm is going to be thinking about $100. That psychological magnetism creates its own momentum. Fourth level, $105. This is the resistance level above $93, and it is not marked on most people's charts. If bulls break through 93s, 105 is the next major area where sellers are likely concentrated. Now you have the complete roadmap. $78 support, $86.50 current resistance, $93 next target, $105 above that. These are not arbitrary numbers. These are levels where the market has shown clear buying or selling interest in the past, and they are confirmed by the 4-hour chart structure. Now let me connect this to gold because silver is not moving in isolation. Gold has been dragging silver off the bottom. That is a direct observation from the chart work. Gold bulls recaptured the $500 level after a series of lower highs that had been building for several sessions. That pattern of lower highs is typically bearish. It tells you that each rally is weaker than the last, that sellers are getting more aggressive, that the trend is rolling over. But instead of resolving to the downside, Gold broke to the upside. Bulls overwhelmed the pattern. That is a significant technical event because when a bearish pattern fails, the resulting move in the opposite direction tends to be powerful. Failed patterns produce some of the strongest moves in technical analysis because all the traders who are positioned for the breakdown have to reverse. With gold above $500 and silver breaking through $78 into $86.50, the precious metals complex is showing coordinated strength. That matters. When gold and silver are both moving higher together, it tells you the bid is broad. It is not just one metal, it is the entire sector. And that brings me to something I think is one of the most important charts to watch right now and one that most people are not paying enough attention to, the gold to silver ratio. Now let me connect this to gold because silver is not moving in isolation. Gold has been dragging silver off the bottom. That is a direct observation from the chart work. Gold bulls recaptured the $5,100 level after a series of lower highs that had been building for several sessions. That pattern of lower highs is typically bearish. It tells you that each rally is weaker than the last, that sellers are getting more aggressive, that the trend is rolling over. But instead of resolving to the downside, gold broke to the upside. Bulls overwhelmed the pattern. That is a significant technical event because when a bearish pattern fails, the resulting move in the opposite direction tends to be powerful. Failed patterns produce some of the strongest moves in technical analysis because all the traders who were positioned for the breakdown have to reverse. With gold above $5,100 and silver breaking through $78 into $86.50, the precious metals complex is showing coordinated strength. That matters. When gold and silver are both moving higher together, it tells you the bid is broad. It is not just one metal, it is the entire sector. And that brings me to something I think is one of the most important charts to watch right now, and one that most people are not paying enough attention to, the gold to silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. When the ratio is high, silver is cheap relative to gold. When the ratio is low, silver is expensive relative to gold. Historically, this ratio has ranged from the low 40s to above 80. Right now, we may be at an important inflection point. There is major volatility around a key support and resistance level on this ratio chart. And here is what I have learned over years of watching markets. Major volatility around a support or resistance level signals indecision and repositioning. Big players are making decisions. They are shifting allocations. And when that repositioning resolves, the move tends to be significant. The ratio could go in one of two directions. It could move higher toward the 79 or 80 level. That would mean gold continues to outperform silver, and silver remains relatively undervalued. Or it could break lower back toward the low 40s. That would mean silver dramatically outperforms gold, which is what happens during the most explosive phases of precious metals bull markets. In every major silver bull run in modern history, the gold to silver ratio has collapsed from elevated levels toward the 40s or even the 30s. That is when silver goes from a good investment to a generational trade. Let me be clear, I am not predicting which direction the ratio breaks. I am telling you that the current positioning on the chart suggests a big move is coming in one direction or the other, and whichever way it resolves has massive implications for how you should be positioned. If you believe the ratio breaks lower toward the 40s, silver is the trade. If you believe the ratio rises toward 80, gold offers better risk-adjusted returns with less volatility. And that is a perfect segue into the data we just got from the mining sector. First, Majestic Silver just hit an all-time high at $27.90. The stock currently trades around $28.10. And here are the numbers that matter. The one-year return on First Majestic Silver is 398%. Let me say that again. 398% in 1 year. The company has a market capitalization of $13.59 billion, and it maintains what analysts are calling a great financial health score of 3.52. But the numbers that really tell the story are in the earnings report. Fourth quarter fiscal year 2025, earnings per share came in at $0.30. The market was expecting $0.18. That is a beat of 66.67%. Revenue for the quarter reached $463.9 million. The market was expecting $403.71 million. That is a beat of 14.91%. For the full year 2025, First Majestic recorded revenue of $1.26 billion with net earnings of $164.9 million, or $0.34 per share. Now compare that to 2024 when the company reported revenue of $560.6 million and a net loss of $101.9 million, or negative $0.34 per share. Read those numbers side by side. 2024, Revenue, $560 million. Net loss, $101 million. 2025, revenue, $1.26 billion. Net earnings, $164 million. That is not a turnaround. That is a transformation. Revenue more than doubled. The company went from a $100 million loss to $164 million in profit. Earnings per share went from negative 0.34 to positive 0.34. The stock went up 398%. And H.C. Wainwright just raised their price target to $30 from $24.50 while maintaining a buy rating. Now, I want you to think about what this means in the context of what we just discussed about silver's technical breakout. Silver mining companies are reporting the best earnings in their history. Revenue is doubling. Losses are converting to massive profits. Stocks are hitting all-time highs with nearly 400% annual returns. And the underlying metal, silver, just broke through key resistance and is sitting at $86.50 with a clear path to $93 and $105. This is not one data point. This is convergence. The metal, the miners, the technicals, and the fundamentals are all pointing in the same direction. But now let me give you the other side, because that is what we do here. Let me give you the bearish case so you have the complete picture. First, the technical case is not resolved yet. Silver is sitting at resistance at $86.50. Sitting at resistance is not the same as breaking through resistance. It could get rejected here. We could see a pullback to $78 or even below. The 6% move on Friday was powerful, but big one-day moves can also be exhaustion moves. A blow-off move, where the last marginal buyer gets sucked in at the top before a reversal. I do not think that is what Friday was, but I cannot rule it out. The next several sessions will tell us. If silver consolidates and holds above $78, bullish. If it reverses hard from $86.50 and closes below $78, that changes the picture significantly. Second, volatility cuts both ways. We just watched silver go from $120 to $64 and back to the high 70s. The largest single-day decline in recorded history happened just weeks ago, a 28% crash in one session. Anyone telling you silver only goes up is lying to you. Anyone telling you the volatility is over is lying to you. If you are not prepared for another $10 or $15 drop on any given day, you should not be in this market at all, or at minimum, you need to size your positions accordingly. Volatility is now a permanent feature of this market. The days of slow, predictable moves in silver are gone. You need to accept that or step aside. Third, the gold to silver ratio could break higher instead of lower. If it moves towards 79 or 80, that means gold outperforms silver significantly from here. In that scenario, being overweight silver relative to gold would be the wrong trade. Some analysts are suggesting that investors seeking to capture further potential upside in metals, but who are wary of volatility, might elect to take exposure in gold over silver at this juncture, given that the yellow metal is leading the charge with less violent price swings. Gold's correction from its highs has been far less dramatic than silver's. Gold has more than doubled over the past 3 years and continues to show structural strength. If you are risk-averse, gold may offer a smoother ride to the same destination. Fourth, First Majestic's 398% return, an all-time high, might be pricing in a lot of future good news. When a stock runs nearly 400% in a year and sits at all-time highs, the risk-reward changes. The company needs to keep delivering blowout earnings just to justify the current price, let alone move higher. Any earnings miss, any production issue, any operational problem in Mexico, and the stock could give back a significant portion of those gains very quickly. Mining stocks are leveraged bets on the underlying metal. That leverage works in both directions. The same dynamics that produce 398% returns on the way up can produce devastating losses on the way down. Those are the bearish arguments, and they are real. I lay them in front of you because you deserve to make decisions with full information, not half the picture. That is what separates what we do here from the scripted shallow talk you find everywhere else. Now let me talk about the ETF landscape, because there is important data here that affects how you might want to position yourself. The two primary ETFs for precious metals mining exposure are the Global X Silver Miners ETF, ticker CL, and the Sprott Gold Miners ETF, ticker SGDM. And the comparison between them tells an interesting story. SEL focuses on silver miners globally. Its top holdings include Wheaton Precious Metals, Pan American Silver, and Kerr Mining. It holds 39 companies. It charges a 0.65% expense ratio. Its one-year return as of February 20th is 198.5%. Its 5-year maximum drawdown was negative 56.79%. and its beta is 0.96, meaning it moves roughly in line with the broader market in terms of volatility. SGDM focuses on gold miners, primarily in the US and Canada. Its top holdings are Agnico Eagle Mines, Newmont, and Wheaton Precious Metals. It holds 40 positions. It charges a 0.50% expense ratio, slightly cheaper than SIL. Its one-year return is 157.7%. Its 5-year maximum drawdown was negative 49.68%, less severe than SIL. And its beta is 0.73, meaning it is significantly less volatile than both SEL and the broader market. Let me pull out the key comparisons. SEL returned 198% in 1 year versus SGDM's 157%. Silver miners have dramatically outperformed gold miners, but SIL's maximum drawdown over 5 years was negative 56% versus SGDM's negative 49%. Silver miners give you more upside, but they also take away more on the downside. SGDM has a lower beta, lower expense ratio, lower drawdown. It is the safer, smoother ride. SIL has higher returns, higher volatility, higher risk. It is the more aggressive play. Here is where this connects back to the gold to silver ratio. If the ratio breaks lower toward the 40s, silver miners will dramatically outperform gold miners. SIL would be the play. If the ratio breaks higher toward 80, gold miners offer better risk-adjusted returns. SGDM would be the play. Your view on the ratio should inform your ETF allocation. This is not about one being better than the other. It is about which one aligns with your thesis and your risk tolerance. And there is one more nuance that I think matters. SGDM does not just track any gold miners. It specifically selects for companies with strong revenue growth, solid cash flow profiles, and low debt-to-equity ratios. It is a quality filter. It filters out the riskier, more speculative gold mining stocks. That is why it has a lower beta and a less severe drawdown. SIL, on the other hand, tracks the Selective Global Silver Miners Total Return Index, which selects based on market capitalization and average traded volumes. It is not filtering for quality, it is filtering for size and liquidity. That means SIL includes companies that might have weaker balance sheets, higher debt, and more operational risk. That difference in methodology is crucial for long-term returns, because over time, quality tends to compound, while leverage tends to destroy. Quick question for you. How many of you watching right now own mining stocks or mining ETFs? And if you do, are you positioned more in silver miners or gold miners? Drop it in the comments because I am genuinely curious about how this community is allocated. And if you are not in miners at all, if you are purely physical metal, tell me that too. There is no wrong answer. I just want to understand where people stand so I can make sure the analysis I bring here is relevant to what you actually need. Now let me bring everything together because we have covered a tremendous amount of data and I want to make sure the key points are sharp and clear. Silver broke through $78 resistance on Friday with a 6% plus move and has continued into the 86.50 resistance zone. The technical roadmap is clear. $78 is now support. $86.50 is current resistance. $93 is the next target. $105 above that. Each level will tell us something about the strength of this move. How price behaves at each level matters more than any prediction. Gold recaptured $500 after a bearish pattern of lower highs failed and resolved to the upside. Gold is leading the charge. The precious metals complex is showing coordinated strength. That is bullish for both metals. The gold to silver ratio is at a critical inflection point. Major volatility around key support and resistance on the ratio chart signals that a significant move is coming. If it breaks toward the low 40s, silver dramatically outperforms gold and the bull market enters its most explosive phase. If it breaks toward 79 or 80, gold outperforms silver and the safer trade is in the yellow metal. First Majestic Silver hit an all-time high with a 398% one-year return. Revenue more than doubled year over year. The company swung from a $100 million loss to $164 million earnings. Estimates were crushed by 66% on earnings and 14% on revenue. The silver mining sector is reporting the best earnings in its history, confirming that the underlying bull market in the metal is translating into real profitability for producers. The ETF comparison between SIL and SGDM shows silver miners outperforming gold miners 198% to 157% over the past year, but with higher volatility and deeper drawdowns. Your choice between the two should be driven by your view on the gold to silver ratio and your tolerance for volatility. But, and I need to say this clearly, the structure being intact does not mean the path is straight. It does not mean there will not be more corrections. It does not mean there will not be more 10 or 15 or even 20% drops. Volatility is the price of admission to this market. If you cannot handle a $15 drop in silver on a random Tuesday, you are either over-leveraged or you are in the wrong asset class. Both of those are problems you need to solve before the next volatile session, not during it. Now, I want to address something that I think a lot of people in this community are wrestling with right now. The question of whether to be in the metal or in the miners. Physical silver versus mining stocks versus ETFs. And the honest answer is that there is no single right answer, because it depends entirely on your objectives, your timeline, and your risk tolerance. And here's the thing that ties all of this together. Every single one of these data points, the silver breakout, the gold recapture of $5,100, the first Majestic earnings blowout, the silver miner ETF returns, they all point to the same underlying reality. The precious metals bull market is not over. The correction from $120 to $64, the 28% single-day crash, the margin hikes, the forced liquidation, none of it killed the bull market. Silver is breaking through resistance levels. Gold is breaking through resistance levels. Mining companies are posting the best earnings in their histories. Stocks are at all-time highs. The structure is intact. Physical metal has no counterparty risk. It does not go bankrupt. It does not have management teams that make bad decisions. It does not have operational problems. You hold it, and it is yours. But it does not generate cash flow. It does not pay dividends, and it carries storage and insurance costs. Mining stocks offer leverage to the metal price. When silver goes up 50%, a well-run silver miner can go up 200, 300, or in First Majestic's case, nearly 400%. But that leverage goes both ways. Mining stocks carry operational risk, political risk, environmental risk, management risk, and dilution risk. They can go to zero. Physical silver cannot. ETFs offer diversification and liquidity. You get exposure to dozens of mining companies through a single ticker, but you pay expense ratios and you are subject to the index methodology, which may not align with your view on which specific companies are best positioned. Each vehicle has a role. Many sophisticated investors use all three: physical for core holdings and insurance, mining stocks for leverage and growth, ETFs for diversified exposure and tactical allocation. Think about what makes sense for your situation specifically. About 70% of you watching right now are not subscribed. If this kind of detailed analysis, the technical levels, the fundamental data, the earnings breakdown, the ETF comparisons, the gold to silver ratio analysis, if this is cutting through the noise and giving you clarity that you are not finding elsewhere, hit subscribe. That is how we grow this channel. I do not chase empty metrics. I do not beg for clicks. I put the work in front of you, and if it adds value, the growth takes care of itself. If it is not for you, no hard feelings. I am here for the people who want substance. 3 things to watch going forward, and then we are out. Number 1, silver's behavior at the $86.50 resistance level. This is the immediate test. Does silver consolidate and push through, or does it get rejected and pull back to $78? The answer to that question determines whether we are talking about $93 and $105 next, or whether we need more time in the $78 to $86 range before the next leg higher. Watch the daily closes. Watch the volume. A breakout on high volume is real. A breakout on low volume is suspect. And if silver pulls back, $78 must hold as support. If it does not, the entire breakout thesis is invalidated and we reassess. Number 2, the gold to silver ratio. This is the chart that will tell you whether silver is about to dramatically outperform gold or whether gold remains the safer bet. The volatility at the current level says a big move is coming. Track this ratio weekly. When it starts moving with conviction in one direction, that is your signal to adjust allocation. If it breaks toward the low 40s, overweight silver. If it breaks toward 80, overweight gold. Let the chart tell you. Do not force a view. Let the data lead. Number 3, mining earnings season. First Majestic just gave us a preview of what this cycle can produce for well-run silver miners. Revenue doubling. Losses converting to massive profits. Stocks hitting all-time highs. As more companies report earnings over the coming weeks, watch whether the sector broadly confirms what First Majestic showed us or whether it was an outlier. If the sector broadly reports blowout earnings, the re-rating of mining stocks is just beginning despite the moves we have already seen. If earnings disappoint, the stocks are vulnerable at these elevated levels. The fundamental data from earnings reports matters more than anyone's opinion, including mine. Let me close with this. We are in a market that most investors alive today have never experienced. Silver breaking a 45-year ceiling. Mining stocks returning 400% in a year. Gold above $5,100. The gold to silver ratio at an inflection point that could produce one of the most significant moves in either metal over the next 12 to 24 months. These are not normal conditions. These are the conditions that create generational wealth for those who are positioned correctly and devastating losses for those who are not. The difference between those two outcomes is not luck. It is preparation. It is knowing the levels. It is understanding the data. It is having a plan before the market opens, not after it moves. It is sizing your positions so that volatility is an opportunity, not a threat. It is being honest with yourself about your timeline. Are you trading the 4-hour chart? Or investing on a multi-year thesis and positioning accordingly? I do not tell you what to do. I do not tell you to buy. I do not tell you to sell. I show you what the data says. I show you both sides, and I let you make your own decision. That is what this channel has always been about, and that is what it will always be about. Substance over hype, data over opinion. Both sides every single time. Do your own due diligence. Understand the risks. Be accountable for your own decisions. If you are over-leveraged, a single bad day can wipe out months of gains regardless of how right your thesis is. If you do not have a plan for what to do when silver drops $10 in a session, build that plan before it happens. And if you are new here, if this is your first time watching, welcome. But understand that this market rewards patience and punishes impulse. Learn the levels. Study the data. Start small. Build knowledge before you build positions. The setup right now is as clear as it has been in months. Silver above $78 support, testing $86.50 resistance, with $93.01 as the next targets. Gold above $5,100 and leading the charge. Mining companies posting historic earnings. The gold to silver ratio coiled for a major move. Everything is lining up, but lining up is not the same as confirming. The next several sessions will tell us whether this breakout is real or whether we need more consolidation. Watch the levels. Watch the data. Let the market show you instead of telling the market what it should do.